What a day we are having in the market so far. Whilst we do see a lot of overpowering green, we're also seeing red, and whilst you may believe that is very typical, we're seeing a lot of companies down double digit, notably meta platforms that we covered earlier in the day, down around 10 to 11%. But our focus on the episode is going to be on the company sandwiched between McDonald's and Yum Brands, that is Chipotle Mexican Grill, and this one is in fact down around 15%. Now bear in mind, we're actually coming out of the extreme fear region that we were sitting in terms of investor sentiment not that long ago. We're also potentially looking to move into neutral in the coming days. We're seeing some good momentum between US and China trade talks, and what we really want to uncover today is, why did CMG tank after reporting their earnings yesterday, and is it a good undervalued buying opportunity? Now straight away, earnings per share in line, that is always good to see, they haven't missed. And revenue, whilst it was a miss, it's fairly marginal, we're talking 1%, and both earnings per share and revenue is up mid to high single digit on a year-on-year comparative, down though both on a quarter-by-quarter basis. And whilst you may look at that and saying, look, it is fairly positive, bear in mind, this is a company that has traded at some very high valuations, and now it is coming back down to earth and very quickly. And what they've done, which is always going to really hammer the share price of the company that does come out to say, is that they've lowered their sales forecast. They're essentially saying that consumers don't have enough money, which we're going to get into, to continue to buy their products. And a lot of people would already say that their products are in fact overpriced for what they are. So they've reduced their sales guidance. Not only have they done that, but just look at this. It is for the third time this year, and that is always going to scream red alarm bells. And we would say tread very cautiously with a company that has done this. Very rare to see, but CMG breaking records and not the ones you really want to be on the end of. And let's just take you back to July this year, where in fact they did pretty much mention something very, very similar. They were saying gloomy customers are buying fewer burritos, which impacted the stock and ultimately led them to reduce their sales outlook. As we said, they've done this 3 times now. Who's to say they may continue this into their next quarter or even before to reduce it even further? And we can see, whilst the share price is down now more than 13%, this was the initial reaction, and they go as far to say that the younger generation in particular are cutting back on those lovely burritos or whatever product it is that consumers are buying. And if we take a look to see what exactly is behind all of this narrative, well, they're expecting full year 2025 store sales to actually decrease now by low single digit. That is not a good look whatsoever, especially when in February they said that this number would grow low to mid single digit. So clearly there are a lot of issues with CMG, which the CEO in particular is pointing to the macroeconomic factor. They're not really taking any of the blame on CMG. They're not saying their products are too expensive, consumer experience may not be what it has been historically, but that ultimately, and very interesting to see, they do have specifics here. Consumers who make less than $100,000, they account around 40% of their customer base to fit within this profile, have slowed down their spending, dining out less often due to issues about the economy and inflation, and goes even further, not just below $100,000, but between the ages of 25 and 35. Very specific, and essentially saying this is where the company is really struggling. And they even go on to say that they're actually not losing the customer. They still like CMG, customer experience is up, but that they're just entering into the stores less often, which ultimately does always come down to the price of their products. If they were a lot cheaper, you would see traffic a lot more. So this is one issue that they are definitely having so far. And I just want to highlight Kraft Heinz because they released their earnings a few days ago, where they're also noticing something very similar. Weak consumption trends. Consumers are buying less products, whether it's some of their bigger known products like ketchup. It's just that consumers are getting anxious. They're either buying less or in fact moving away to cheaper alternatives. But this isn't the first time we're hearing that potentially consumers are starting to slow down, and now Wall Street are also getting concerned. We've seen quite a large flurry of analysts that have started to cut their price targets. As always, just want to make you aware that analysts will always be reactive rather than proactive. So when we do look at analyst targets, do in fact take it with a pinch of salt. These are just estimates and they're no more or less qualified than ultimately an investor who takes the time to just read whether it's the company's financials or macroeconomic news. And we have City analysts who said it is a bit challenging to call a bottom as of today, but that their price target right now sits at $44, a reduction from their initial at $54. And they're also accepting that they expected quite a bit from this company. They say while we knew that traffic had slowed down for Chipotle into the fall, they were surprised by the magnitude of what was reported in their latest earnings and admittedly perplexed by how suddenly this traffic weakness has come about and actually gone against what the CEO said, and it's not in their views about affordability. So I'm interested to see what really they believe is the catalyst for this poor earnings. Now look, the company itself as of today is down 15%, trading around $33, $34. It's down 44% in the last year. Year to date, pretty much similar. Over the last 10 years now, it's pretty much, as we'll come to show you, not far off the S&P's performance. It did pretty much peak last year where it was trading around $66, $67, also at the back end of 2024, and now trading at a 52-week low, something it did hit towards the beginning of the market open, quite somewhere away around 50% below their 52-week high. Having said that, we have a buy rating from Seeking Alpha, very weak, of 3.66. Remember, 3.5 is what is needed to flip this into a buy. Wall Street, on the other hand, 4.37, very near to a strong buy of 4.5. Quant coming in, going against the grain, calling this company a sell as of today. Now we want to reflect on the valuation overall, and it does get a D-, although this information is before the huge drop, so the forward P is a lot lower than 34, but still nonetheless will be trading at a premium to the sector, and this goes to show you that historically CMG has traded very high, and whilst we get a pre-drop 40% discount, it's saying right now CMG is trading at more than a 50% drop than what they were historically valued at. Price to earnings growth will now be below 2, which yes, does get us excited, but still above the sector at 1.66 and interestingly below their historical. So to wrap up the valuation, we're getting a company that's trading above the sector on both a forward PE and a price to earnings growth. Doesn't really mean much. As always, within this bucket, there will be low quality companies. But what's fascinating to see is we're looking at a significant discount now than their own 5-year average on both a forward P and PEG basis. We'll just highlight, even though this company is trading at a PEG below 2, which you could say straight away, very excited, you want to smash the buy button. Let's just highlight high quality companies that we believe are in fact better consideration, because on a PEG basis, they're trading lower. Nvidia, even with the growth it's seeing in both share price and underlying fundamentals and metrics, is trading at 1.5. You've got Google and Meta after the drop trading around the 1.9 to 2 region, as well as Amazon, although they're due to report their earnings after the close today at 1.8. So just one thing to consider, yes, CMG may look good, but there are also other companies that we would say probably take precedent in terms of serious consideration. And these metrics go on to back up what we just said. Their average restaurant sales has been decreasing from December 2024. It's continued that trend into the quarter that they've just released. Not a good sign. You want to consider companies that are ultimately growing. And we can also see their comparable restaurant sales. Yes, there was an increase from the previous quarter, but look, I mean, it wasn't that great. It was negative 4%. We're talking very marginal, if anything, when you incorporate inflation. That's 0.3%. We can clearly notice the downward trend for a company that I just want to remind you was previously trading at very high valuations. And with being in line in this latest quarter, over the last 4, CMG have either outperformed or been in what analysts were expecting, so a 100% track record. Yes, that is nice, does give you faith that when we look at their next 4 quarters, they will ultimately hit that, but the growth isn't that high. We're talking 3% to close out 2025. And more importantly, if you're investing or considering, you need to understand the underlying metrics. First one, free cash flow per share. Is it consistently increasing over the longer term? Yes, for the most part, that is what we're getting. Expectation to continue over the next 12. Good to see. We'll just flag though, earnings per share data and earnings in general data is available. We just don't use it because it is susceptible to manipulation by management through accounting. And then sales growth, nearly double digit every single year, but clearly a drop in the last 12 months. And also the expectation from what we heard from management Third time this year they've cut their guidance, so don't expect a great 2025, at least for that metric alone. Total sales, we'll cover it shortly, but in fact their top line has nearly tripled over the period, where whilst they don't pay a dividend, we have noticed they've done only a little bit of share buybacks, and we can see the reduction in 2024 to Q3, again very minimal, so nothing we would say to seriously consider. ROIC, one of our favorite metrics, we want 10% or more to give us faith management are able to effectively allocate their capital. Very inconsistent, but good to see above 10% from 2021 and only increasing into 19% on a trailing 12-month basis. And then margins, very, very important because we want to understand, are we getting efficiencies? Is it increasing over time? Now, from the lows of 1% in 2016, it is in fact increasing, sitting at 17. And there was a lot of talk about bringing automation into the business so that they could reduce their costs and therefore lead into the continuation of this upward movement. Hopefully that is what we will get to see. Free cash flow margin inconsistent, but at least above the minimum 5%. And then we get to the net debt to EBITDA, does highlight the balance sheet strength. These are the number of years it would take them to pay off all of their debt net of cash on hand. Below 3 is what we want to see, where it was above that, nearly at 4 in 2016. But on a downward trend, that is good, and 1 over the next year is something we can take comfort in, but as always, definitely something to keep an eye on and perhaps consider when we get to our margin of safety on the DCF model. And talking about growth, they get a B-. Last year, growth was 9%. Whilst we have 11% here, we've just heard 3 times they've cut their guidance, so nowhere likely that we'll see anything near this number. But the sector overall, as we can see, is struggling, not great, low single digit. What is impressive is their historical numbers, and that is probably why they were valued at a much higher rate. We're talking around the 15% region. Now, if you believe this, earnings per share is projected to hit 16% on average over the next 3 to 5 years. Yes, nice to see above the sector at 10, but look again, like revenue, EPS historically was much higher at 24.2. And then we move to profitability, where we note an A, 40% gross margin, a little bit above the sector at 38.5, improvement to their own 5-year of 39. Bottom line, also strong, 13%, a lot more above the sector at 4, and we can note efficiencies to their 5-year at 10.5. Ending on here with their cash from operations, 2.1 billion, significant improvement to the 5-year at 1.5. Now, what are the institutions doing with their 91% ownership? We have 7.5 billion worth of sales over the last year, and we notice near double the buys at 13.1. So clearly bullish in the last year, but maybe we see a flip to that sentiment in Q3, 280 million selling versus 99 million worth of buys. If you want to see another quarter where they were selling more than they were buying, in fact, you can see Q1, although by a small amount, in 2024. And then the flip side to that is, what are the insiders doing with their 0.8% ownership? No insider buying in the last year, little bit of insider selling of 6 million, nothing in this latest quarter, nothing in Q3. In Q2 though, that is where we see the bulk of it at 5.7 million. As always, remember, insider selling isn't a bearish signal typically because they sell for many reasons, personal and financial. And we'll also just flag super investors what they're doing. And what we can see, which is why we're drawing this out today, is that Bill Ackman holds around 9% of CMG in his own portfolio. But a better takeaway of this is, over the last few quarters, he has been reducing the number of shares he holds. In Q1, he reduced it by 13%, in Q4 by around 14%, and you can see with, in fact, CMG, was in fact a much larger holding. Another point which is actually quite interesting to see is that an analyst went to many different CMG locations across the US to understand whether or not the process of producing the food was consistent, and you can see the weight essentially of the bowls that he bought was very different in nearly every location. Just something that we thought was quite interesting to point out. And then when we compare the performance of CMG over the last year, massive underperformance, negative 34, S&P up 18, QQQ up 28. Over the last 10 years, massive underperformance again, up 60%, the S&P up 110, QQ up 142. And over the last 10 years, you can see pretty much in line with the S&P, up 225, 228. QQQ though, massive outperformance, near 500%. Question is, can they outperform over the next 10 years? Otherwise, you're better off investing in a low-cost ETF, perhaps like the QQQ that has massively outperformed in the past. but important, we want to point out here, past performance is not an indicator of the future. The other thing to understand is, are the issues CMG is facing isolated to them, or do we see their competitors in fact also seeing something similar? Now, over the last year, they have underperformed quite significantly. The only ones, in fact, where we do see quite a huge decrease. Over the last 5 years, they're also one of the worst performing. And over the last 10 years, they are sitting in third place. So the real conclusion here is, in the shorter term at least, over the last 5 years, given the drop we're seeing in the shorter term, CMG hasn't been the best company to have in the portfolio. What will happen in the future, that is for you to consider whether or not this can turn things around. And we'll also reflect on the income statement and balance sheet, kicking off with the revenue. Nice growth over the period. As we said earlier, they've near tripled their top line from $4.5 billion 10 years ago to now sitting at 11. But we want to understand, what is the theme on the bottom line net income? Is it consistent growth? And look, for the most part, from 2016, the answer is yes. That is great to see. Going from 476 million, a drop in the following year at 23 million, and since then growth has been very impressive, now at 1.5 billion. So historically, both revenue and bottom line net income do tend to follow each other, which is always reassuring as an investor. And then the other thing is a quick health check, total cash versus total debt, where cash has gone from 663 million to now sitting at 1.4 billion. Question is, what does the total debt look like in comparison? As always, one number here in pure isolation will not give anything away. And what we're seeing with the total debt, it has actually been increasing over the period. 3 billion 10 years ago, now sitting at just under 5, and that is why on the net debt to EBITDA, we did in fact see 1. Alarm bells aren't ringing just yet at a high level view on the balance sheet, but definitely something to incorporate in your overall investment thesis. And before we jump into our valuation, we want to let you know we have released our latest free weekly article. We draw on every single Sunday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year. November's copy will be dropping in a few days' time, and on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. So our intrinsic value gets to just under $40 today, derived solely from the DCF model. Now look, the last few years, they have managed to grow their free cash flow at a very strong rate, average at 41, but we want to be very conservative today and use 12%. What you'll notice is a low, medium, and high, 8, 12, 16 respectively. And as always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, CMG or any others. Now, one of the important takeaways is, given the drop now baked in to the price, if you're adding around $33, $34, is 9.9% growth to the future free cash flow. As always, this will tell you at a high level whether you see this as under or overvalued. If you believe the growth will be much faster, undervaluation, much lower, overvaluation. And using the middle rate of 12% in conjunction with the discount rate, it gives us the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, getting to $39, indicating 16% upside. You may say that's actually way too conservative and you want to be a lot more optimistic. At 16%, $53 indicates 58% upside. Likewise, you may say, no, these are too high numbers and you want to be more conservative. At 8%, $29, downside of 14. Now, we're not done there, because we always like to take through the middle rate and use a margin of safety, kicking it off with 10%, execute buy if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, which flags this at a buy at $35. But already we're seeing, based on the current price, if you believe that growth of 12% is reasonable, then you're getting a 14% MOS. If you want a 20% at that growth rate, buy at 31, at 25, 29.50. Now, Wall Street themselves, very bullish, even cutting their price target on average. See this at $48. That is 43% into next year. They clearly believe this is a bit of an overreaction. We can also highlight, for those that believe 8% should be more reasonable, you're not getting a margin of safety as the intrinsic value sits lower at 29. This is highlighting there is a 16% premium if you're buying today, and we'll show the other end to close out the episode. If you believe growth should be 16%, which is lower than the 10-year, lower than the last 2 years, then in fact you're getting a large MOS of 36%. So give us your views today. Is Chipotle Mexican Grill a buy, hold, or complete avoid? And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.